Welcome to Real Talk, real estate discussions with Andrew Kirsh. In each episode, Andrew interviews industry leaders. We'll hear their real-time opinions on today's market, their background and unique career highlights, and guidance for newcomers to the industry. You can find this show at www.sklarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Now here's the host of Real Talk, Andrew Kirsh.
Episode 8 of the Real Talk. Happy New Year. Great time, 2023. I want to thank everybody for all the messages that people have sent me about the podcast, that it's resonating with so many people. I really appreciate the feedback. Please leave a review, whether you're listening on Spotify or iTunes or YouTube. I truly appreciate the feedback. This is going to be an interesting year. It's a year where a lot of people who I'm speaking to think that at least the first quarter, maybe the first half of the year, could be really slow, and that once we're in the second half of the year and the Fed has stopped raising rates, then activity will pick up. I think it depends on asset class by asset class and location by location. I think obviously office has a ton of headwinds and a lot of issues to sort out, and we're going to see lenders selling notes and offering opportunities on their office portfolio. On multifamily, I think we're going to see lenders extend, and they're going to recognize that we're in a tough refinancing market right now, and that they'll give borrowers 6 to 12 months of extension in order to get through this choppiness. I think retail is doing well. We're doing more retail, grocery anchored centers now than we have in the last 5 years. Obviously, industrial is still strong, and specialty asset classes like self-storage and senior housing, industrial outdoor storage, all very strong. So we'll see how the year plays out, but it'll definitely be interesting. I'm really excited for my next guest. It's the first time we're having two guests on at once. Steve Ludwig and Eric Freedman, co-founders of not one, not two, not three, not four, but 5 companies, all concurrent. They have a real estate empire, from multifamily owner-operators through NextGen, asset management through Coastline, a construction business through Turnaround Solutions, a construction materials business through Tesoro, and then finally they launched Valletta Capital, a private debt fund. Really interesting guys, good friends of mine, clients of mine, and their business model is to find a variety of income streams that are resilient to all economies. I think you're really going to enjoy our conversation, and let's listen to both Eric and Steve. What is going on? Eric Freedman, Steve Ludwig, thanks for joining us.
I'm so happy.
Thanks for having us.
Yeah,
great to be here.
If those of you are watching on YouTube as opposed to listening on Apple Podcasts or Spotify, you wouldn't see that Steve his grin is so wide right now. He's so happy to be here. Eric is legitimately happy to be here. But first of all, Steve, what is that hat that you're wearing?
So every year, Eric and I mobilize between 60 and 80 of our friends to join our company Team Coastline, to participate in an annual charity triathlon to raise money for the benefit of a great 501c3 called Challenged Athletes Foundation, where we hand out thousands of grants a year around the world for people who need adaptive sports equipment. So for people who have lost limbs through birth defect, accident, injured veterans, et cetera. It's really an empowering organization, and we're thrilled to be a part, as we have been for over 10 years now.
Oh, that's fantastic. I know we've donated and supported your charity, and that's it. It's
fantastically generous, and we appreciate it.
Wasn't trying to plug my own generosity. I was actually curious of the hat, but then it reminded me of the great charity work that you guys do. So you mentioned Coastline. People know of you as Coastline. Some know of you as Next Gen. You have a debt fund, Valletta. You've got a construction company. What are you guys? Who are you guys? I mean, I don't know.
Well,
who are you?
I'll say this. I'm gonna guide this into a story that Steve can tell better than I can tell. But I think the growth of our company, the vertical integration of our company, I used to use the word grew amebically. It sort of grew out of need and essential, and what we needed to do to maintain and grow our assets from there, our business plan. But I think it kind of all started, Steve, now that I think about it, when my mom was sitting next to you at that legal event 20 odd years ago. If you want to tell
Well, that's where you and I started, which is 100% true. But even one step before that, yesterday I had the pleasure of spending the afternoon with my last boss 20 years ago when I was at Colony Capital. And he very politely told me I no longer had a job there. And as I was touring him around our building materials warehouse, which now encompasses around 100,000 square feet and growing, and then touring him around a handful of our land entitlement sites, to which we're looking to build 1,100 units in the South Bay, he just looked at me and he said, Steve, I'm really impressed with what you and your partners are doing. He goes, it seems like nothing's really changed with how you operate. He goes, when you're in your mid-20s, I kind of remember you as the guy who we would tell to do something one way. And you kind of said, nah, I think I'm going to do it my way. And then we'd say, no, we'd like you to do it our way. And you kind of look at us and say, it's not going to happen. And you've always gone out and done it on your own terms. And that's exactly what Eric and I do, which is, we start one thing. And once we dive into one business, we might see problems in an affiliated business that we're working with. And we kind of wake up one day and say, you know what, we could do it better if we did it on our own. And so we'll rally a group of, or we'll reach out to people that we think would be very helpful or beneficial to us in a particular industry. We'll start a new business. We'll give everyone ownership stake in a business. And then we'll head down the path of creating a new enterprise that can add value to a pre-existing one.
I was just going to mention, Eric, the fact that you and Steve at least met, or one of your first encounters was at a legal event. I can't imagine how boring that must have been for both of you, because I can't even tolerate legal events. And Steve, it definitely resonates. I think what you were trying to say is that you may not have fit well in an institutional environment and didn't take direction from perhaps the quote unquote, the way it's supposed to be. Well, hence that's why I have my own law firm as well. So we have a lot in common. But so why don't you guys describe, maybe Eric, if you want to, because I want to get to like how this conglomerate started and how it grew and how you're navigating, today's choppy waters, but just give our audience an overview of the different divisions that you guys have and what those divisions do.
So we've got acquisitions, because we're buying buildings, and we've been doing that since 2002. We then asset management. So we have a team that's overseeing those assets, overseeing the progress and the business plan as we underwrite it. We then have our property management company that runs the day-to-day. And I think that's what separated us from other companies out there, is we run our buildings ourselves. And that sort of happened after the last downturn. We were spending a lot more time at our assets than our property management company was. And property management companies are mainly fee driven. They're not business strategy driven. So they just want to get people in there. They want to push their fees. We looked at it and said, hey guys, what if you attack it this way? How do you connect your underwriting in Excel to your operations? And we're able to combine that and bring that together. That then fast forwarded to our renovation company, because how can we save costs? How can we do stuff on our own and control the cost of renovation, of updating? And then fast forward now, about a year ago, we launched our materials business, or I should say broke it off from our renovation company, and recently launched a debt vehicle, because as the markets change, that becomes a need. And we're there to adapt to the market and to fill that need.
So when you're at a cocktail party and someone asks you guys, what do you do? What do you lead with?
I'm the lead off.
A shot of tequila.
I'm
extra anejo.
All right. So after a couple of shots,
I'm the Mickey Hatcher of the 1988 Dodgers, Andrew Kirsh. We fill every role. No, we're a vertically integrated real estate conglomerate is what we've become.
So the way I like to look at it is we can be dangerous in any conversation. Every time when you go to a conference, I like to say, I like to try to, in any conversation, if you can't make business, make a friend, so to speak. But sometimes you talk to someone who's, if I'm at a conference and I'm acting as, Steve from Next Gen Apartments who does multifamily value add, and I'm talking to a counterpart in the business, and we're both actively trying to, look at buildings, we can have a very bland, generic conversation and lie to each other through our teeth about what markets we love and what rents we might get and how much we're willing to pay. But no one's really telling the truth because nobody wants to give up their, unique business plan or idea that they have. Whereas Eric and I can go into that conversation and, have that same conversation. And then we can say, oh, well, if you're buying apartments in Southern California, who's financing those for you? Who's renovating your apartments? Where do you buy your building materials from? So there's 3 different avenues that we could generate business at one of our companies on top of the, boring conversation that you started with.
You calling me boring?
I didn't say law. We're not starting a law firm, that's for sure. I don't understand that world. I lean heavily on you. But and a lot of it's just been born from the fact that we get very, very frustrated with the way other people do things. I grew up in Boston. We're not as courteous as you West Coasters, Mr. Freedman. I know you're a Midwesterner, Andrew. So maybe less courteous, than Eric, but that's also more courteous than Boston. And so we're kind of like, hey, we don't like the way you do things. Pound sand. We're going to do it better. And we're going to do it ourselves. And we're going to offer those services and take out some competition.
Well, just to correct you, I did grow up here in Los Angeles. I was only educated.
Oh, you went to college there. Wow, your formative years.
Yes. So, all right.
East
so
of the 405, though, right, Andrew? You were east of the 405?
East of the 405, absolutely. East side of town. You're a West Sider. So what of all of the different avenues that you guys transact and participate in the real estate business, what are you most excited about sitting here at the end of 2022 going into 2023?
So I think we're in a time of tremendous uncertainty. And when Eric and I think about how we should evolve going forward, we think about the past and we think about 2008 and what transpired then, which was similar to what a lot of people are going through right now. We were new syndicators into the business. We had all these great hopes of huge promotes because values were skyrocketing. And then the rug got pulled out from underneath us. And so as a result of that, that experience, that knowledge, we realized that we needed to have a variety of streams of income that would be resilient through all cycles of the real estate market. And so as we sit here today, as it relates to our existing real estate portfolio, we never overly aggressive. We weren't overly aggressive in buying new assets for the last 2 to 3 years. So we really missed out on that. We looked at the market and we said, everything's very frothy right now. The cost of an existing apartment building is bumping up against the cost of new construction. Let's back off. So we don't have are there things that we're certainly watching in terms of our legacy portfolio? Yes. Do we have any fire drills right now? Thankfully, no. So we're certainly watching prices drop, not to a point where we're feeling aggressively. We're not in buy mode quite yet, but we're getting close to that. So that's an opportunity we're really excited about. Our building materials business is booming. Supply chain issues globally have driven a tremendous amount of business to us. And so we're currently distributing luxury interior finishes nationally. And we're in a round of fundraising right now to expand the business with not just delivering materials nationally, but opening up additional locations to have a national footprint. That's really exciting. On our construction business, which is local to Southern California, we have a captive labor force. So we're booming on that front. And on our real estate finance platform, Valeta Capital, we launched really at the right time. We started making loans just a few months ago, so we don't have any legacy portfolio issues there. And as the capital markets are getting squeezed and people are looking for lenders, we're sitting here waving and saying, hey, we're open for business, come on in. And then our last platform right now that we're driving hard on is we have acquired a handful of either vacant land sites and covered land plays to do our multifamily high density entitlement. And that's really exciting. And we're still looking for additional sites, but we certainly recognize that regardless of where asset prices go and rents, they might go up or down 5% in the next 12 months, who knows? But there's still a tremendous housing shortage throughout the state of California, and exceptionally short in Southern California, and more specifically where we are in the South Bay of Los Angeles. They haven't really built anything in 35 years. And so we very quietly and under the radar amassed, an 1,100 unit portfolio of to be entitled units, and we're really excited about that. So there's a lot we're excited about.
Yeah, I mean, we could do an hour show on each of those verticals.
We could.
Yeah. So Eric, talk in general or in total, how many employees do you guys have?
We've got, within the separate companies, property management, we have a little over 50 employees. Those are everything from our managers to our maintenance techs to our corporate staff. The turnaround solutions to Soro, which is what Steve was talking about, the renovations and materials business, we have about 35 employees. And we have a lot of people out in the field every day renovating, because Turnaround Solutions is the renovation company and Tesoro is the materials business. And Valeta has about 8 employees right now. So that's a growing entity. So we are kind of, it's my role, I'm sort of staying in the lane of a CFO position. So I'm sort of overseeing each one of those operating accounts and then also the ownership accounts of those entities. So it is sort of get the right people in the right place to do what they can do. And then everyone's doing their job, right? So there's really no fire drills that occur because that was the first thing we learned, right? You got to get the right team, the right mentality. You got to have people that are motivated. Steve and I were motivated. It's cliche, but we started on his dining room table in his apartment in Hermosa Beach.
So let's go all the way back to that dining room table in Hermosa. How did you capitalize your first deal?
So the very first deal that we bought, I had left my private equity job, and we put a 7-unit building into escrow.
Oh, we lost Steve. This is live podcasting. Eric, take over for Steve. By the way, for those are watching, Eric actually just killed Steve and is now the sole, along with Jimmy Killian. There's now only 2 founders of this company. Oh, Steve is now.
But we'll always speak highly of Steve. No, it's funny as Steve logs back in. The joke is, and I said it at his wedding. His grandfather gave an incredible speech, and then Steve said, "I'd like one of my best men, Eric Freedman, to say something." And I said, basically, Steve, I'm your longest relationship you've ever had. And and it's true, and it kind of goes back to the beginning, right? We talk about teams and emotions and getting along. When Steve and I started the company, it was in October I came down and started helping him out. And my background was diligence at Arthur Andersen, which that's an entirely other podcast as well.
Not as fun.
And we said, hey, listen, can we work together and still be friends? And Steve and I are both A personalities. Steve much more A personality than I am. But when we started working, we said, oh, listen, let's give this a shot. So from October, through December of that year, we just kind of went down there and just see if we could get along. Because at the end of the day, the friendship was more important than the work.
I'm sorry, I had a technical issue.
No, that's okay. We fired you, Steve. So
good. I'm back. I'm on fire. I'm unfireable. You can't get rid of me. I'm like kudzu. Anyway, to answer your question about how we.
Hold on. I was in the middle of an anecdote. Let me just finish the anecdote, and then we'll cut.
He was talking about his best man speech at your wedding, Steve. It was very emotional.
This just trying to get back to what he's saying is already longer than his best man speech.
So we basically, that was the whole mantra, is could we be friends? And because that's what ruins things, right? Business, money, things that deal with that, could we get along? And I think the fact that we're coming up on 20 years now proves that, that first 90 days that we took to say, could we work together and still at the end of the day be friends, held true. And that's really what's held true and what's helped grow our business and company, because at the end of the day, the employees, our partners, everyone looks at us, they know that we're two heads of the same body. And that goes a long way when you argue bet the jockey, not the horse.
So whose body are your heads on?
I like to say he's much bigger and stronger than I am.
Okay.
I can answer that. That's a tough question to answer.
It's too tough. I should have waited for
I think the reality is it's generally easier to work with people, to become friends with people you work with, than to go to work with people that you're friends with. That's a very dangerous, difficult thing to do. And Eric and I truly, it's been very fortunate. We bring very different, skill sets to the table. And, as friends and business partners for as long as we've been, it's truly, you have to be able to have the hard conversations at work and then walk out of that office door, put it all to the side, and be able to have a beer together and keep that friendship strong. And remarkably, have we had our arguments and disagreements over the years? Absolutely. No relationship of 20 years doesn't have those, but we work through them very quickly. And the underlying, mutual concept is that we tremendously respect each other. And without that, you can't have a partnership. And, beyond that, and I'd say even beyond that, the trust factor. I truly trust Eric with my life, and I hope he feels the same. I feel like he does. Eric, do you?
This is going
to take the fifth meeting. I don't understand.
Well, this is going to turn into a Hallmark movie that for the Christmas holidays. This is going to be beautiful. So we're launching this podcast at the right time. All right, look, can we get into the real estate? This is what my 5 million followers and listeners want to hear. Okay, maybe not about the relationship between Eric Freedman and Steve Ludwig.
They would rather hear about what color we paint a building than letting Steve and I delve into our personal relationship with each other.
You're right. Let's go back to that. All right. So we're back to your dining room table in Hermosa Beach. How'd you capitalize your first deal or the first few deals?
Sure. So the very first deal we put, as I had said before, I technologically bonked 170 units into escrow in Sherman Oaks for $16 million. And
by the way, that's quite a first deal. Usually
quite a first deal,
like a fourplex.
I knew how to put together a financial model and really not much else. And so I used the internet, which was available to me at the time. And I looked up and I had an Excel spreadsheet of about 300 potential real estate investors that I got from irei.com and their glossary of private equity firms. And I just went on the website, I found the acquisition person, and I started calling one by one. I think at about 168 phone calls, I got to a company who said, great looking investment. Who are you? Never going to invest with you. You're never going to close this deal. And when you don't, I'm going to be the guy that buys it right behind you. And he hung up the phone on me. And then eventually, by the time I got to about 300, where my list stopped, I had received a call from a young gentleman who now runs Carlisle's real estate practice by the name of Jason Hart. He and I were co-analysts together at Prudential Securities in their real estate investment banking group straight out of school. We spent a night at the bar together when we were 22, hanging out. And he, at that point in time, had left and joined the Pradium Group in New York, a real estate private equity firm. And he, calls me on my cell phone and on the package, and he goes, "Is this the same Steve Ludwig with I got totally shit-faced with in New York?" And I said, "Absolutely." He goes, "I have this real estate offering memorandum in front of me, and it looks like a decent deal." Lo and behold, Pradium funded our first investment. I give up.
Oh, we were hearing it. Steve gave up on us. Eric, take it from there. But I can't believe that so most people's trajectory is to start with smaller deals syndicate, pass the hat, friends, family, and grow from there, and then eventually graduate to a joint venture structure. You guys out of the gates had a company that was willing to provide you, I assume, what, 90 to 95% of the equity?
Yeah. So I mean, I make the joke, it's not really a joke, but I make the comment, at the end of the day, we're finance geeks, right? We're not, that's what we are. And so Steve, who started Prudential Banking and Prudential Investment Banking, went on to Colony Capital, knew bigger deals. Prudential's not doing a duplex or a triplex. They're
No,
buying big
of course
things.
not.
Colony is buying big things. I was at Arthur Andersen. We were doing transaction work with Universal, big companies. And so when we came into the game, that's what we understood. Like a duplex wasn't something we would do. We understood you find a building, you find the equity, and the equity is the private, whether it's the private REIT or the public REIT, and they'll fund 90%, and then you got to go raise 10%. I think the big learning.
But usually, Eric, an institutional private equity capital provider isn't going to back a company's first deal in real estate that they want to see a track record.
So that goes back to the relationships, right? That goes back to being transparent and, betting the jockey, not the horse. And I know I've already said that once, but it was Jason Hart, right? So he saw the book, he knew Steve, he had worked with Steve, right? So the guy, you've worked with the guy, you understand it. It's in a geography that you don't trust anyone else to be in, or you don't know anybody else there. So it was one of those things where we operate, and a mutual friend of ours, John Monkarsh, likes to say, it's a small sandbox, right? So real estate we operate in, everyone knows each other. You want to be good to the person. My dad used to say there's always a third conversation. The conversation you have in the meeting, you leave, you're going to have a conversation, and they're going to have a conversation about you. So you always want to be presentable, and you always want to make sure that you leave as a positive person and a positive note. And so that was the connection. It's funny, without that night at a bar when they were 22 in New York, I doubt we get that first deal done. But it goes down to, who do you want to work with? It's not always about the money. You don't want to get into a deal where it's about the money, because the money, right, the 90% partner will find a way to burn you at the end of the day, or doesn't care about you to help you grow. The deals we've done, the partners we've had, and when I say partners, not friends and family, but the big REITs, we work together. We've had issues, deals, we work through them, we work together for the end goal, because we all know we're working for the same end result, the same goal. So I think without that connection, that human connection, which is today difficult to do with COVID and videos and everything, it's hard to get that first, $16 million deal done. So
over your 20-year period, and we're focusing, at least for now, on the multifamily owner, operator, value add type of strategy that you guys are well known for. What percentage of your deals, at least on the equity side, are capitalized through these joint venture relationships where they provide the vast majority of the equity? And what percentage have you done syndications of friends and family? Have you done funds and capitalizing it that way?
I don't want to break it out as a percentage. I would say we have two different business plans. Mm-hmm. Business plan A would be real estate, call it 10 million, 15 million and under, in good core locations that we can buy. We can set up a financial structure to hold the asset forever, to sell it in a year if we wanted to. And that's with friends and family. And so we're able to work through that and sort of grow that business plan, right? And those are the 15 unit, the 20 unit, the 25 unit buildings in Culver City and Beverly Hills and the South Bay. Plan B is to buy bigger assets with the REITs. And with those, what you end up doing is you end up giving up control. Yeah. Right? At the end of the day, you control the day-to-day, but you don't control, what's happening. What's good for the fund is not necessarily good for you, type.
And that's what I tell my clients and contacts every day, where especially people who have done syndications and feel like they want to graduate. Steve, you're back. And you're in your car now. I love it.
Andrew, you're very finicky about having a solid background. So I left my cozy environment where I was set up. I had a charger. I had everything going. And I went to an office. And this is what you guys get. But I think there's a lesson to be learned here in the world of real estate. And it's about backup and redundancy. And so even though I was gone, my partner Eric was here to carry the show.
He was. Yeah, he did say he's taking 90% of the promote on your next deal. But besides
He's earned
that,
it.
yeah.
As you can see, it's like he's like Steve Sachs and I'm Mickey Hatcher, and I had to come in and I had to hit a single and keep this game rolling, crawl the home plate to hit home plate.
All of our viewers or listeners who are under the age of probably 35 or 40 don't even know who you're talking about, especially if they're not from LA. And Real Talk is a national and global podcast. So when they're listening in China and India and Africa and Australia, they may not know these obscure 1988 Dodger figures who won us a World Series and probably are really our only legitimate World Series, because 2020.
What do you have against South America, by the way?
I didn't say South America, did I?
I'm like
No.
Ole Gunnar Solskjaer for Manchester United, and Steve's like David Beckham.
All
I'm
right.
going to come in the 89th minute and score the goal that he couldn't score, but I'll let him take the pictures. I'll let him take all the prize.
That's good. You are great partners for that. So we were in the middle of talking about the different ways you guys are capitalizing your deals, the joint venture model, the syndication model, and the pros and cons of both. And so, as I was about to say before Steve rudely interrupted me by rejoining our podcast,
You're welcome.
So you have this choice, right, of herding cats and having 10, 20, 30 investors in a small deal where they're putting in, I don't know, $50,000, $100,000, $250,000 increments and answering the questions of many investors on one deal, but you're controlling the decision-making process versus doing the larger deals, but having little to no control, really, and working for someone, working for a group, working for a New York-based Wall Street private equity company, but you're able to do larger deals. Is there a better or worse, or you just have those two different business models?
So as you correctly alluded to, there are pros and cons to each. I think, beyond there being a better and worse, I think there's also the word necessity. And regardless of what you think is better or worse, one of those might not be an option to you. And so your path may have been chosen for you. And over time, as you grow a track record, then as you have more optionality, you can then make those decisions. I think that sometimes, there's capital that's better suited for different types of deals. If it's a large deal, it might be even, too many people in a deal that even though you might have control of the deal, there's just too many investors. If you do fund a large deal and it's 2022 and you've got to refinance it and you highly leveraged it at the acquisition, and instead of refinancing out your 75% loan to cost, you can get a 60% loan to cost, and you have to make a massive capital call, and you have 50, 100, 200 investors, and now all of a sudden you're really trying to herd cats for people to reinvest into the deal. Some do, some don't. Then you got to go back to the ones that do and see if they want to go after and take down the ones that didn't. It can be a lot of work. Whereas you might have an institutional investor who, they believe in the investment long term. There's a capital call. They put up the additional money. You put up your co-investment share, and you're done. I think in terms of what your hold period is, if you are a long-term holder, institutional capital is less of a match than private capital.
Yeah.
So I think there's a lot of factors, and I think the way that we approach every deal is considering, the pros and cons that we've learned over time, and then matching the appropriate capital to the deal.
It's interesting when you were talking, Steve, about that infamous night in the bar with, was it Jason Hart? When you guys were 22 years old. Similarly, a deal like that happened where you called me a few years ago and you said, do you know anyone who may be interested in about 14, 15 smallish buildings, but aggregate, it's a big deal in the South Bay. And I was having dinner with Ryan Kaplan of Goldman Sachs. And I said, hey, Ryan, by any chance, are you interested in 14 or 15 deals in the South Bay or 14 to 15 properties in the South Bay? He's like, sounds interesting. Do you like the guys? I said, there's one I like, There's one I don't really like. Now you're going to have to make that decision.
Did you notice the Freudian slip that you said there? While you were trying to, haphazardly put me down, you said I really like, and then you actually had to backtrack and say really don't like. So you really said I like Eric, but you were going to say I really like Steve, but then you reversed course. I caught that. Just want you to know that. Keep going, please.
No, but and maybe this is just a way to pat myself on the back, perhaps, but it is all about the relationships and right timing. Where I happened to be having dinner, you called, and I don't know if the two of you would have connected, and you guys have been able to transact on, hopefully, is a very successful deal for you guys and for Goldman, and the rest is history.
Yeah, and you talk about, and by the way, first and foremost, thank you for that. It was a fortuitous introduction that's gone very well. Ryan's an outstanding person and person to work with too. But we needed to raise $40 million of equity in a very short period of time. We had a $2 million non-refundable deposit out there. And again, if we had a long enough runway to go out and raise $40 million of capital to get that deal closed, or if we could at the time, maybe we would have. Under that specific set of circumstances, we needed a large check very quickly, and we wanted an assurity of close. And I'm going to call it a relatively complex yet straightforward apartment transaction. And so having an institutional partner made a lot of sense.
Yeah. Well, so we're sitting in a interesting period. Came out of COVID, 2021, easily the most voluminous year of my career last year, heading into early first half of 2022. The engines kept on revving, and tons of deal flow, cap rates coming down, interest rates basically at zero, and then overnight the whole market has shifted with interest rates spiking, cap rates going up. The access to capital has really diminished, both on the equity side and on the debt side. So you guys are in so many different positions, from apartments to ground up to now a debt fund, which I want to talk about, and on the construction materials and labor side. How are you positioning yourself going into 2023? Where do you think you're going to be most active?
Let me answer quickly, and then I'll let Steve talk about Tesoro. But I think our covered land plays, our entitlement plays in the South Bay, have really hit the perfect timing, to be honest with you, because those things lie dead for 2 years while you're getting things entitled.
And what are you trying to build there in your different locations?
What Steve mentioned earlier, the 1,100 units over there. But the reality is, it's a dead period when you're entitling something. Whether it's covered or not covered, you have periods where it's not entitled. So I think that we've hit perfectly, because it's going to take that time period where nothing would happen anyway, whether the market's great or not. Our mortgages, our interest is in place, and we're working through the processes, and the cities are excited to work with us. So I think for that standpoint, we've sort of hit the ball on the head there. We'll pass it off to, I guess you're over there, to Steve to talk about his thoughts on Tesoro and Turnaround Solutions, which is our renovation materials business for 2023.
Just to also add to the development side, perfect timing also, because construction costs have spiked 40% in the last 2 to 3 years, and now they're starting to trend down. So we've avoided that spike. Anyone that's got a floating rate construction loan outstanding right now is feeling that pain. We're avoiding that right now. And because the majority of our land play deals are covered and rented out at a positive cash flow scenario, we can be patient and be more, we can choose when we want to launch construction in the future without it being punitive to our investment. So on the Tesoro side, the building materials company, we are, again, we've organically grown the business, utilizing profits from our companies and from the business itself to expand. But right now, the volume of purchases that are coming towards us is greater than, call it, the cash on hand. So we're doing what any young growing business is doing, which is starting down the capital raise path so that we can get out ahead of the curve and be able to competently process all purchase orders and plan for future growth. So that's very exciting for us. And as we've alluded to earlier, it's really about building a plus team, which we have to date, and continuing to add A plus players to that team. So it's not just a building materials business, is part sales and then big part logistics. So we're really building a logistics company and the infrastructure around that, which is really exciting. And we're just gonna keep our heads down and grow the business throughout 2023. We probably expect to do 4 times the volume in 2023 that we did in 2022, strictly because we had a very strong 2022, but it's a young business, so the rate of growth is obviously exponentially higher early in a company's life cycle. And then on the real estate finance platform, Valeda Capital, again, it's better to be lucky than good oftentimes. And we don't have a problematic legacy portfolio because we don't have a legacy portfolio. We're new to the market. And while there are lenders dropping from the market in droves, we're standing tall, well capitalized with a lot of cash to lend. And that's a great opportunity for us. People will always be opportunistic in their buying patterns. And so there will be the group of people that are on the sidelines waiting for the market to stabilize. And there will be a lot of people out there who are making opportunistic purchases, that are making aggressive offers from a timing perspective. They might be paying market, but to get the deal, they have to close quickly. And that's where a company like Valeda Capital comes in, because we can close in as little as 2 weeks. And our borrowers can feel confident that, in our execution. And so we're really excited about that business plan as well.
The one thing we have taken very seriously, we don't joke about, is the fiduciary responsibilities we have for our companies and for our investors. So I think when times come to this point where the markets are changing, and we saw it in 2008, our investors know that they can trust us. Our investors know that if they have a question, Steve or I or one of our other partners get back to them immediately. And I think that sort of relationship with your investors, whether it's the REITs or whether it's your aunt or uncle or your friend or your friend's friend, helps build that asset for you. That these are people that I want to work with. These are fun people. But at the end of the day, these are people looking out for me, so I can sleep at night, because I know when they get up in the morning, they're worried about my investment with them. So I think that's a key proponent, especially when you hit a market like this, where people kind of go, I don't really know where to invest. I have money. I hear the market's going bad. What do I do? And they look at Steve and I and they go, I can trust those guys.
And they're heavily invested alongside us. And, we always tell people that, look, in good times, we're all gonna, ride the good times together. But when times turn, and they do, because the market's cyclical, we're heavily invested side by side with you. And if we have to walk through fire, we're going to do it together. We're not going to abandon an investment.
And I've seen it both literally and figuratively with you guys. All right, I like to end my podcasts on a little lightning round. And so the first question for both of you, not long answers, so quick answers, Mr. Ludwig and Freedman. If you weren't in the real estate conglomerate business, which is what you call yourself, what would you be doing?
Eric, I'll let you go first.
Probably business management.
Scintillating.
I think I would be doing, I would somehow be involved with great white shark research, free diving, spear fishing, monster shark catching YouTube channel?
See, that's the type of answer I'm looking for, Eric. So on the
I
next
can go back.
question.
I'd be the business director at AC Milan.
Okay, there you go. So
Sure.
I thought you were going to say something with curating 1980s reference movies references, something like that.
He is the king. He's the king.
I know he is.
He's the king.
Yeah.
All right. Best advice someone has given you.
Eric, go.
Best advice someone has given me. What I said from my dad, there's always a second conversation.
I thought it was witness nothing, live longer.
That's just the mantra I live by, but yes.
I think two pieces of advice that I love cliches. So, but at lunch one day, one of our investors is also a now retired real estate attorney. He asked me a question. He looked at me and says, "Do you want to be rich or do you want to be wealthy?" And I said, "I don't understand the difference." And he looked at me and he said, "Wealthy people never sell." And that separately, somebody else said to me, I think it was Ben Leeds said to me, "When you sell, you lose."
And so are you going to take that advice?
We try to hang on to everything as long as we can. It kind of goes back to, going back to the beginning of our earlier conversation about private versus institutional capital. Institutional capital generally has a sale mandate associated with it, and private capital tends to be more flexible and long-term if you pitch it that way.
So in 2023, do you think you're going to be net buyers or net sellers?
That's a tough question.
Buyers.
Yeah, I want to say buyers. But let me flip this lightning round back to you, Andrew. We moved our business to you. What about Steve and I and our companies made you feel that you would get into business with us?
That's a good one.
So, by the way, you are the first podcast guest to ask a question of me. So now I have to be prepared. But since I am also a narcissistic at heart, I love to be the one who does answer the questions. So on a serious note, I do remember our meeting in El Segundo, in your office along with Jimmy. What I see in you guys, and this isn't bullshit. It's A, why I wanted you on my podcast. B, why I want to work with you. C, why, Steve, I know you're down in San Diego and we don't see as much of each other, but we definitely should. I know you've invited me to come down along with Will Walker. But I mean this, that we're blessed with a lot of clients and I see a lot of different personalities, but it's very important to work with people, whether it's an attorney-client relationship, whether it's a partnership relationship, where you truly, genuinely respect the other, you like the other parties, and you trust them. And so when I got that phone call from you, Steve, of who do you know for that deal in the South Bay, that portfolio deal, not only did I not have any qualms in putting my neck on the line to introduce you to people, I relish that opportunity because I know that you guys, A, would make me look good, but B, you're just really trustworthy, good-natured people. And it's important because I think one of you were saying, when times are going well, that we all experienced, especially last year and leading up to COVID, it's easy for I don't want to say easy, but it's easier for people to do well and, sing Kumbaya, but you really understand and know the true character of someone when you go through tough times, when you go through those first 4 to 6 months of COVID, when you're going through a rising interest rate environment, when you're going through a liquidity crunch. And so I would trust you guys implicitly and enjoy working with you. So how's that as an answer?
I like that answer. That was good. There's some edits we could draft something. I should say this as well. We do have our third partner, Jimmy Killian. Age bracket wise, Jimmy's younger than us. Steve and I are about the same age, although he's older a little bit. But I'll say this: COVID, you had mentioned, was very interesting because what I learned during COVID is that there were days I didn't talk to Steve. Maybe 2 or 3 days I didn't talk to Steve or Jimmy or whatnot. But at no point in that period, and I've talked to them about this and they agree with me, were we concerned about what we were doing, because we all knew what our roles were, what we were trying to accomplish, and we all trusted each other implicitly, and Stephen mentioned it before, to get that job done. And I think if you're going to grow a company, if you're going to have partners, you have to have that trust that everyone is working for the common good that is the goal. And so I think COVID kind of proved that out. We knew it before, but I think COVID kind of made it very clear, which was, something to come out of something horrible.
Yeah, no, absolutely. It tested all of our resolve. Steve, I'll give you the final word.
Is this a closing argument as opposed to like a question? Is this just like an open mic moment for me? Beware of this. I'll take it. As far as I'm concerned, I think I have 11 minutes and 4 seconds because you said this was an hour. So
we're going to cut it shorter than that because I have advertisers that want, to utilize a lot.
I think we're 4 of the 5 advertisers. So, I think this is well, first of all, thank you for having us both on. This has been a lot of fun. And second, I think the reason why we haven't hung out in a while is because the last time we dined together, I think that you got bored of me asking like all the different wait staff interesting questions about their life. And, you wanted to move on from the dinner with me, but I'm not insulted by that. I'm just, I'm curious about people in general, but we could do it again anytime you want. But lastly, I think what's going to be interesting is we have had such a long, run of success in the real estate industry, especially the multifamily industry, that people forget to dot their I's and cross their T's and realize that a solid foundation is paramount to getting through challenging times. And in 2008, when Eric and I were young bucks in the industry and, feeling really positive and energetic about everything that was going on, or prior to that, we started to see some of our peers in the industry disappearing and going into other industries, and there being that shakeout. And I think that we're going to go through another shakeout right now. And so, you don't want to see anybody fail. We only want to see people around us, our peers, be incredibly successful. But, opportunistically speaking, it's been very heavy in our sector. And so we're looking forward, eyes wide open, with tremendous excitement for the opportunity that we know is lying ahead. And there's still so much capital on the sidelines. It's going to be very hard to find those opportunities. But, for everyone out there, staying hungry, staying focused, doing your job and finding opportunities, they'll be there.
That was quite the final word.
That's my Bill Belichick speech. I'm a Bostonian, so I always try to,
they have a big game tonight. I'm not sure when this podcast will air, but Bill's paying.
Go Pats. Right. Go Pats. Let's go.
Let's do it. And Freedman, you're a Raider fan. I don't know what to say about them really this year.
I don't know anymore what I am. They moved away when I was a kid, but I do still have my Los Angeles Raiders hat. Maybe that's why I'm stuck in the 80s. My life stopped.
Andrew, who do you root for?
I'm a Dodger fan. You cut me open, I bleed Dodger blue.
Has anybody ever do you know anybody who grew up in Los Angeles and roots for the Chargers?
I met a guy yesterday who did. I swear to God, I did. And I was like, "You grew up here and you root for the Chargers?"
I've got close friends who went from Raider fan to Charger fan, and I think it's similar of how I became a Clipper fan. I became a Clipper fan when they moved to Staples Center in 2000 because I was too cheap to pay for Laker tickets, and I became a Clipper fan. And I think Charger tickets are less expensive than Rams tickets. That's it.
Right.
So, guys, I truly appreciate your time. I appreciate your friendship and your business, and I can't wait to see the future of your 42 different divisions and conglomerates, and I know at least one of them will be successful. But thank you guys for coming on to the Real Talk.
Thanks for having us. This has been a lot of fun, and we appreciate all the support that you and Sklar Kirsh has given us since we made the change to your law firm. It's been a great run together.
I appreciate it. All right, guys. Thank you.
Appreciate it. Thank you.
You've been listening to Real Talk, Real Estate Discussions with Andrew Kirsh. You can catch prior episodes at www.sklarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Thank you for your positive reviews, comments, and sharing this show with others.